Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie, and today, is there a case for full reserve banking? After a question from one of our listeners, we thought it was a good time to have a look at who gets to create money in this economy and whether it needs to be regulated more. Now, I might be on dodgy territory here, but my understanding of fractional reserve banking is that banks loan out more than they have deposited with them. So their deposits are only a fraction of the loans they issue. But I mean, that means there's an element of risk, isn't there? I mean, if the banks don't hold a big enough fraction, Steve.
Oh dear.
Have we got off to a bad start?
Yes, we have. And the reason is because you quoted the textbook happening, and the textbook is wrong.
Cool.
Well,
there we are.
And I don't just, it's not just that I have to quote the Bank of England on that. Thank God I can quote the Bank of England on that these days, because it used to be a case of having to turn to non-orthodox economists who actually understood what was going on. But they were a minority, of course. And now I can turn to the Bank of England, which has got no balls behind it. Equally, also even the Bundesbank. Fractional reserve banking does not exist.
Right.
It is a textbook model, which is a fallacy. And this is one of the most frustrating things for me, not just in terms of dealing with conventional economists, which of course is always a frustrating experience, but even with the public as well, because they've swallowed this myth as to what causes trouble in the banking sector, and it doesn't happen. It simply can't happen.
So why the myth then? So I mean, or maybe it's just people getting the wrong end of the term. So I mean,
No, it's a myth. It is actually a myth. I mean, it's partly terminology. I actually had this discussion with somebody on Patreon today on this very point. And what gets confused, and I can understand the confusion happening.
It's because, well, people think banks lend out more than they have.
Yeah, and they do, which means they can't be lending it out of something which has got a fixed size to it, which is the reserves, because you're going to lend out more than you've got. Where the hell do you get it? You don't get it from where you've got it at the moment. You've got to be making it somehow, and you can't make it out of reserves. So this is I've got to go right back and start talking something very, very boring. So go get a cup of coffee, everybody.
Oh, yeah.
It's accounting, and we divide every asset for somebody is a liability for somebody else. So that in the aggregate, the sum of all assets and all liabilities in financial terms is zero across the entire planet. But individuals can have assets greater than liabilities so long as other entities have liabilities greater than assets. Now, if you subtract your assets from your liabilities, you get your equity. And one, which is sometimes called capital, and that also is partly where this confusion comes from. And the gap between assets and liabilities is your net worth. Now, for banks have to, effectively by the definition of a bank, banks have to have positive equity. Their assets have to exceed their liabilities. If, as happens during a financial crisis, if the value of assets plunges and stock market crash occurs, or bonds get written off, or you have to terminate loans, in that situation, the assets can plunge, the liabilities remain constant, because it depends on other people. Yeah. Other people have control over your liability side. You can have negative equity, and that's what sends you bankrupt. So a bank has to have positive equity. Now, what then happens is banks, when they are first formed, imagine you have a bank. You just say you put the hat around a few friends and you raised $1 billion, and you then got some poor clerk and lawyer to draft the documents necessary to become registered as a bank, and you therefore start with $1 billion in equity, no assets and no liabilities.
Mm-hmm.
You make your first couple of loans to a couple of friends, a few $1 billion there, a few $1 billion there. Let's say you've got up to $10 billion worth of loans. Those $10 billion worth of loans create $10 billion worth of deposits. And at that stage, the ratio of your equity, which is $1 billion, to your loans is 10 to 1. And that's pretty much the level that banks tend to operate at. They're highly levered institutions.
So is that 10 to 1 type ratio?
Nothing to do with their reserves.
Right. Okay. All right. So it's just your capital. It's the capital reserve rather.
It's the capital you lever, not the reserves. Now, what people make the mistake of thinking they lever the reserves somehow, and this is where the textbook gets it wrong. And I can quote the Bank of England and the Bundesbank on that front to anybody who thinks the textbook can't be wrong. Yes, they can. And the textbook myth is the government creates money by, say, they're giving money to a dole recipient, and the dole recipient takes that paper check. You go back to the days of paper checks for this sort of stuff. goes back to the bank and deposits that paper check in a bank account, and then let's say it's $100 extra, then the bank, the mythical money multiplier model, triple M, the mythical money multiplier model. Actually, hang on, it's 4, quadruple M, mythical money multiplier model. Okay,
what have you been drinking? Good. What are you on today?
I'm in Amsterdam. Be careful. Where was I?
You're on the quadruple M.
Quadruple M. Okay, there's no intoxicating substance. The only substance I can see this morning is coffee. Okay, but you got me wired. I think I've had 3 or 4 coffees so far today, so I'm a bit on the wired side. So the mythical money multiplier model argues that the government sets some ratio between the reserves that banks have on hand, which is one of their assets. Mm-hmm. It's a non-income earning asset as well. The model says they set a ratio between the reserves and their deposits. And for every deposit of $10, you must put aside $1 of that in reserve. So, and then if you get to the stage where your deposits are 10 times your reserves, you can't lend any more money unless you get more reserves. So that's the model.
Right. Okay.
It is false.
But okay. So because you're calling that $1 billion that you had in that example you gave. So I had $1 billion and I lent out $10 billion. Mm-hmm. That's not a reserve then. That's my. You're saying that's my. It's my
leveraging your equity.
Right. Okay. Cool.
Which is what banks do.
And I have to keep that just in case everyone all of a sudden there's a run on my bank. I've got to make sure I've got 10% of that money. So No. Cool. Well, at least we're getting this sorted out.
What happens is because the banking is not understood by the banking regulators, there's a handful who do, but the ones who set the policy don't understand the system. What has happened is because they've all done economics degrees instead and swallowed these stupid textbooks, they put the controls on the reserves as if the reserves are the limit on your lending. It's not. It's your equity position which is the limit. Now, therefore, what they've got is no controls over the equity side. So if a bank is quite conservative in its business operations, it might work on an equity gearing of equity to loans gearing, let's say of 8 to 1.
Right.
So that $1 billion worth of equity, they might be willing to put at $8 billion worth of loans, and then you'd need 12% of those loans to go bad before you'd wipe out all your equity. Mm-hmm. If $1 billion of the loans went bad, or if you lost $1 billion worth of assets on the in terms of valuation of shares and stuff like that on the bank portfolio, then you go to zero equity and you'd be in big trouble. But that's pretty hard. That's a very large downturn. Now, what happens during a bubble like the dot-com bubble and the subprime bubble and so on is that banks get more and more adventurous in how much leverage they're willing to take on. And we know from the records of the financial crisis in 2008 that companies like Morgan Stanley and so on, which actually operate as banks and formed the Bank of America, other banks of that nature, they got to the stage of having ratios of virtually 30 to 1.
Right.
What that means is a small fall in the stock market would be enough to wipe out their equity base. And there's it's funny in hindsight, it wasn't particularly funny at the time, but I think it was Morgan Stanley, the chief executive of Morgan Stanley, or Goldman Sachs, it may have been Goldman Sachs, got in touch with the then Treasury Secretary of America, who was Hank Paulson, who used to, of course, be a leading manager in Goldman Sachs. And he was saying, look, you've got to really do something when the crisis really hit badly towards the end of 2008, I think it was, roughly August, a year after it began, but when it got really, really serious about August 2008, gave Hank Paulson a call and said, you've got to do something. We're about to go bankrupt. And he said, how long have you got? And he said, about 3 hours. Now, what was happening is, literally, I'm not joking, the stock market was falling that rapidly that the valuation of the shares was one of the assets the banks, let's say it was Goldman Sachs. I could be wrong on that front, but I'd like to be right. Let's say that Goldman Sachs, and they were watching the stock market plunge, and they knew that the rate the plunge was going on, within 3 hours, that rate of plunge kept up. Their assets would have fallen enough in value to be less than the liability. They would therefore have to declare bankruptcy.
Right.
Okay? Now that is unregulated. That is allowed to be any level you like.
And hence it goes the other way, of course. So if they take that 1 billion and say, well, let's magically turn that 1 billion into 100 billion.
30 billion. Let's not go quite that far. 30 billion.
Well, 30 billion, then that's a lot of extra cash, which people are then investing, and they're probably investing it in things like equities. So it is pushing up the share market.
It's a positive feedback loop that gives you expansion and contraction in the valuation of assets. And that's one of the fundamental causes of instability in a capitalist economy, is that being there. And while we're all currently trying to control by using reserves, which play no bloody role whatsoever.
Right.
So it's a bit like, imagine the captain of the Titanic, which is a pretty good analogy, and you've decided, oh my God, we're about to hit an iceberg. Quick, somebody go and order some croissants. Order croissants?
So it's the ratio.
You'll crash. Okay? Yeah, but ordering croissants forces the boat to change direction, because the weight distribution in the kitchen means oh, come on. But fundamentally, it's a model like that.
You are smoking something. You have been smoking something. So the asset. So it's really it's not like an asset ratio. It's the ratio of how much you're lending out to the assets that you're holding. It's
how much. It's a net worth ratio.
Right.
What you're creating in loans compared to what your net worth is as a bank.
Right. And there's a lot more to that discussion with Professor Steve Keen. It's in answer to a question from one of our podcast listeners asking Steve, why don't you recommend a full reserve banking system instead of fractional reserve? Well, we've already heard that he believes fractional reserve isn't a thing, but more discussion on that if you listen to the full podcast. And to do that, you've got to subscribe. You can either listen on debunkingeconomics.com and choose one of the subscription plans there, or you can become a supporter of Steve Keen on Patreon. If you go to patreon.com/Prof Steve Keen. If you dedicate $10 or more per month to Steve's work, then you get access to all of these podcasts included in that price. And that's it for this time on the Debunking Economics podcast. Thanks for listening. Hopefully you'll join us back here soon for the full version.